If you are one of the millions of people whose life doesn't quite fit neatly inside one country's borders, maybe you're a digital nomad, maybe you travel constantly for work, you know the pain.
Oh,
It's
yeah.
that moment.
Yeah.
Your attempt to pay for something, maybe something critical or even just dinner, is just denied.
Yeah.
And your bank, the one holding your money, suddenly feels less like a partner and more like a bureaucratic jailer.
Exactly.
We are doing a deep dive today into a source called Pay Without Borders, the Traveler's Guide to Crypto Cards. And it doesn't just complain. It really maps out this fundamental conflict between traditional static finance and the new reality of global living.
Right.
So our mission is to unpack its big claim that these new crypto cards offer borderless finance, real financial freedom, and a way to reclaim control over your own funds.
Okay, let's unpack this. It's such an essential topic because the workforce, it's changed so much faster than the banking system. You've got millions of highly mobile people, global citizens, remote workers, but their financial tools are still from a world where you stayed put for 50 years.
Right.
So the traditional system sees that mobility not as a lifestyle, but as a risk. And that tension, that's where all the friction comes from.
And the source material really hits the nail on the head with that friction. It starts with that immediate pain point, the feeling that banks don't travel with you. It's just a classic systemic failure. The analysis points out that banks will actively block your payments the moment you trigger some internal, usually way too sensitive risk algorithm. They freeze your card and the entire system just seems to seize up across different time zones.
And that inability to handle sudden geographical change is the first clue, really, that the system's broken for a modern traveler. Think about it. If you land in Singapore at 11 p.m. and try to pay for a taxi, and your bank back in, say, London flags it, you're stranded instantly. The source really emphasizes this. These systems are built to protect a domestic user from a remote hacker, but they fail completely when the actual user is the one who's suddenly remote.
The source also connects this sort of micro-friction to the broader structure. The whole system seems designed to create what the guide calls constant cross-border friction. Can you elaborate on that? Why do our standard cards just hit a wall when we leave our home country?
It really comes down to a network of interconnected stop signs. The moment you cross that border, your transaction has to pass through all these complex interbank settlement layers, regulatory checks.
KYC and AML.
Exactly. Know your customer, anti-money laundering, but in two different jurisdictions. And traditional cards rely on these huge, slow networks like SWIFT for that international transfer. They weren't built for instant global use. They were built for daily batches of data. The system slows down and hits that regulatory wall because it has to account for every single local rule and fee.
And while a block transaction is frustrating, the biggest hurdle the source highlights for, digital nomads is how banks trap them with the requirement for proof of residence.
Yes. This is the ultimate catch-22, isn't it?
It really is.
It's an institutional absurdity. If you don't have a fixed home base or you're trying to get set up in a new country, banks demand local documents, utility bills, rental agreements. They force you to be locally anchored before they'll give you the tools to move freely. I know people who've had to keep apartment leases they barely use just to get a basic bank account because they spend a few extra months somewhere else.
It's forcing a static 20th century definition of identity onto a dynamic life.
Yeah.
You're literally penalized for being mobile, which raises a big question. If mobility is increasing like this, why is our financial infrastructure still so rooted in fixed borders? It feels like it's designed to maximize institutional control, not empower the user.
Exactly. And that systemic demand for fixed residency is where these legacy institutions just fundamentally fail the modern user. If your primary goal is financial freedom, you have to find a way around the system that demands physical proof you belong somewhere.
And that's the pivot point in the source. It moves right into the solution, the freedom of crypto cards. The contrast is, well, it's profound. Traditional finance says you have to be geographically fixed. These cards promise an account that travels with you.
The whole philosophy shifts. Instead of asking, where do you live, these solutions ask, where do you want to spend?
So the core function described is the ability to pay anywhere with crypto. Now, for anyone listening, this isn't really about paying a street vendor in Bitcoin. That's still pretty niche.
Right. It's not about that. It's about leveraging the enormous existing network of Visa or MasterCard and bridging it with the assets you actually control.
That bridging function is the key then.
It is. The process involves instantly converting your crypto funds to the local currency, fiat currency, wherever those payment rails are accepted. But we should be precise here. The source mentions converting stablecoins, your Bitcoin, your Ethereum. And while you can use Bitcoin or ETH, the functional day-to-day spending is almost all done using stablecoins.
Okay, and why is that distinction so critical for someone trying this out?
It comes down to risk and utility. If you use something volatile like Bitcoin, you're introducing transaction risk. The price could drop 5% between you deciding to buy a coffee and the transaction actually settling.
Ah, okay.
But stablecoins are pegged usually to the US dollar, so they give you the borderless, decentralized benefit of crypto without the price volatility. They're really the essential tool for spending. You get the best of both worlds.
What's fascinating here is how that just fundamentally shifts control. By keeping your assets in a stable, borderless format until the last second, you just bypass all those clunky steps that banks use to impose fees and controls.
And the guide lays out the 3 essential features for a successful travel card. And they all point back to this idea of user autonomy.
The first 2 are sort of table stakes for any modern payment tool. Worldwide acceptance on existing rails and support for digital wallets like Apple Pay and Google Pay, because honestly, who wants to carry plastic anymore?
Sure. But the third point is the real differentiator. It's the source of the financial liberation. No hidden border fees. This is where you save the money and establish control.
Let's spend a moment on that. Traditional banks, they thrive on those percentage points every time you step outside their network. They treat borders like profit centers, foreign transaction fees, terrible conversion rates. How does a crypto card mechanically eliminate that?
It avoids that slow, expensive interbank settlement process entirely. With a traditional bank card, the bank and all these intermediaries take a cut while moving money slowly between countries. With a crypto card, especially one using stablecoins, the exchange is instantaneous and automated. You hold the asset, and the moment you swipe, the card provider performs a real-time conversion. It bypasses that old fee-heavy correspondent banking network.
Which means you get much better exchange rates.
Way better rates and often 0 border fees. It's a direct financial relationship, cutting out all those middle layers.
That makes the shift incredibly compelling. And the source doesn't just talk theory. It brings up a specific example, introducing PintoPay and positioning it as a service built for global movement.
This is a perfect illustration of what that dedicated fintech approach looks like. PintoPay is detailed as a modern card designed specifically to solve this problem. The key feature noted is that it works in over 150 countries with, and this is the important part, 0 border friction.
So the core value prop of PintoPay is really about providing the reliability of the Visa and MasterCard network, but injecting the freedom of crypto. It's a solution that actually respects the dynamic life of a global citizen.
Absolutely. It takes that promise of borderless finance autonomy control and pairs it with the need for daily utility. If you're a digital nomad, you don't need another theoretical wallet. You need a tool that works for groceries and software subscriptions everywhere. This is a practical solution that puts financial power back in the hands of the user.
The source goes even deeper, though. It provides critical context by categorizing the entire landscape. It breaks down 3 distinct types of crypto cards, which is really essential for a user to understand what they're actually signing up for.
Right. If we connect this to the bigger picture, you see that not all crypto cards are created equal. Understanding these categories is key to making an informed choice about your security and control.
Okay, let's start with the first one, exchange-based cards.
So these are tied to a single, centralized platform. Think big names like Binance or Coinbase. They're convenient if you're already on that exchange, but their functionality is often geo-restricted. You're basically replacing your bank boss with an exchange boss.
So a centralized point of failure.
Exactly. If that exchange pulls out of a country you're in, your card might become useless. It kind of compromises that promise of true financial freedom.
That's a huge distinction. Which brings us to the second category, the FinTech solutions, which is where PintoPay sits.
These are defined as independent solutions designed specifically for flexible global payments. Their main focus isn't exchange volume, it's utility for the global citizen. Since they aren't tied to one exchange's regulations, they can often offer wider geographic acceptance. It aligns much more closely with that goal of autonomy.
And the third category is white label cards. These are interesting because you might not even know you're using one.
Correct. They're not the brand on the plastic, they're the underlying tech stack. White label providers supply the infrastructure that allows other brands exchanges, fintechs, to launch their own crypto cards quickly. They're kind of the unsung heroes enabling this whole shift.
So the core message, regardless of the category, is that power is shifting. We're moving away from legacy institutions that demand proof of residence and impose fees toward dynamic solutions that prioritize the mobile user and put control of your funds back in your hands.
The trajectory is clear. The move from static banking models to these borderless solutions is driven entirely by the demand for autonomy and mobility. As the number of global citizens grows, the pressure on the system to prioritize fluidity over control is just going to keep increasing.
This deep dive really confirms that the battle against hidden fees and frozen cards is being won by technology. For you, the listener, the choice is no longer just between a checking account and cash. It's between an outdated infrastructure and modern solutions, like the ones offered by PintoPay that are built for global movement. It's time to explore the alternatives that actually respect your freedom.
And before we close, let's just leave you with this final thought. Given those inherent differences between the three categories, exchange-based, fintech, and white label, which category will ultimately offer the most sustainable and truly decentralized definition of financial freedom in the years to come? Will it be the independent disruptors, the platforms with huge user bases, or the technology enablers working in the background? Something to mull over until our next deep dive.